In this talk, I want to make a case for CBDC, that is the central bank digital currency. Now, of course, before I make the case, I must tell you why it is hard to make a case for CBDC. Okay, so I'm going to first tell you why CBDC is not so obvious, why the use case for CBDC is not that obvious, and then I'll try to make a case for it. Now, there are three affiliations that I've shown here. One is, of course, with IIT Madras, where I teach a course, computational economics, where I train students to basically. I also am affiliated with SASKEN Technologies, which makes mobile devices, and specifically I've worked on projects for securing mobile devices for the defense and so on. So that is one context. The third context is a fintech company that I started a couple of years ago. A lot of what I will say will be based on my experience in that fintech company. Okay. So how does one understand central bank digital currency, CBDC? This diagram, which is also called the money flower diagram, it's a Venn diagram, kind of explains CBDC in a very nice way. So when you say central bank digital currency, clearly there are two words there, central bank and digital. So those are necessary things. So you have currencies which are not digital, like cash, for example, and you have currencies which are digital. So central bank digital currency is clearly digital. And whether it is issued by a private agency, like Bitcoin, for example, or is issued by a central bank. Okay? So the intersection of central bank and digital, so that intersection basically defines CBDC. And in that intersection, you can further divide it into 4 quadrants based on whether it's widely accessible or narrowly accessible, what is called wholesale CBDC, right? Or retail CBDC. If it's narrowly accessible, means it's wholesale, it's meant for banks to do settlements among themselves. And retail means it's meant for us to transact, right? To do payments and so on. And you can also use another dimension, whether it's token-based or account-based. I'll discuss a little bit more about it. So if it's token-based, then there are some challenges of making it token-based. And if it's account-based, then there are some other challenges. Okay, so we've discussed those challenges. So basically, there are 4 kinds of CBDCs that you can get based on whether it's token-based or not, and whether it is narrowly accessible or widely accessible. Okay, so everybody knows that there are advantages for central bank digital currencies. Primarily, I would say that the advantages comes because the CBDC, if you implement it correctly, has the dual nature of being like a bond, right? Which means it's like an asset, because you can have interest-bearing CBDCs. And it also has the liquidity of cash. So it has the liquidity of cash, and it has the asset-like nature of a bond. So it's kind of a unique digital instrument that combines the benefits of cash and bonds, okay? But of course, the way in which CBDC is implemented in many countries, like for example in India, we don't give interest-bearing CBDCs, so that bond part has been taken out. I'll explain why, okay? And it's super safe because it's directly issued by the central bank from its reserves directly to customers, and it doesn't use intermediaries like banks and so on. So there is no danger of a bank run. For example, today, we know that many mid-sized banks in the US have gone bankrupt and so on. There's a run on those banks. CBDC, there is no danger that there'll be, just like having cash in your hand, right? So it's very, very safe because it's a central bank instrument. And there are no inflation risks, at least when it's remunerated. If you give interest on CBDCs, then it can protect against inflation risk. So it's not surprising, therefore, that many central banks, in fact, there was a survey that was done in 2021. They found that very large number of central banks, as many as 86% of the central banks in the world, are experimenting various kinds of versions of CBDC to implement. 60% actually experimenting, and 14%, that is 1 in 7, are in pilot stage. And I understand that Indonesia is also in pilot stage. A lot of what I will talk about in this presentation is based on the India experience, but I believe that there is a lot of commonality between India and Indonesia, and potentially many of the things that I'm saying could potentially be used in Indonesia as well, okay? So India, exactly 1 year ago, India introduced its CBDC, right? We are sitting in November, so November 1st, the wholesale version of CBDC was introduced, and on December 1, the retail version of CBDC was introduced in India, with 3 main goals. The first goal was financial inclusion, and I will have more to say about financial inclusion later. Digitized economy, in India's economy, like Indonesia's economy, is largely informal. About 85% of the economy in India is informal, and because it's informal, you have no way of tracking and tracing things that are happening in that economy. If those transactions happened digitally, then you could trace it, right? So that is one of the things. And the third is simplifying cross-border settlements, trade settlements. Hidden behind these 3 goals is 3 goals which the RBI didn't write down, but actually which is in the back of their mind, The first goal basically is to kill the threat of cryptocurrency. We already discussed it in the previous presentation. Cryptocurrency is a dangerous thing that people worry about because it is used for many illicit things. And so you want to kill the threat of cryptocurrency. And you want to reduce the dependence on dollar, especially for emerging countries like India and so on. The dollar getting stronger and stronger is hurting our economy quite a lot. The fact that most of our trade, even with third-party countries which are not US, has to be settled today in dollar is hurting us, right? And the third, of course, is how do you find a method of managing monetary policy without dealing with cash? Okay, so these are the three things. So the target basically that the RBI set, that RBI is India's central bank, what it set basically was 1 million retail transactions, daily transactions, by December 2023. We are in December, nearly in December 2023, and I will tell you where we are shortly, right? We are nowhere close to that. Now, one of the things that basically encouraged the government to set such a strong target is the success of what is called the Unified Payment Interface, the UPI, which is a digital payment platform that was created in India, which pretty much everybody in India uses for all kinds of retail transactions. That's been growing roughly at about 100% every year. So you can see that in 2023, the financial year 2023, 84 billion transactions were carried out using UPI with a total value of 139 trillion rupees. Okay? So very, very substantial amount of transactions that UPI is handling today. Okay? So compared to that, if you look within 1 year, CBDC has not done very well. Today, against a target of 1 million transactions per day, CBDC is only doing about 18,000 daily transactions, right? Very, very low. It's about 2% of the target that the government set for itself, all right? So one could say roughly that CBDC is not working. You could say that by looking at this chart, all right? And in fact, if it's not working in India, it's not working in many countries where CBDC has been introduced. So Sweden and China, for example, are two countries that early movers in CBDC. They are also reevaluating because their experience CBDC also has been very poor. In Europe, in fact, there was a committee that got together and they asked a large number of questions. Some of them are very fundamental questions. For example, how would you encourage the adoption of CBDC? Are you going to encourage intermediaries? If so, how are you going to incentivize those intermediaries? If that incentive is given to those intermediaries, who will bear the cost of those incentives? Will it be borne by customers or not? Things like that, okay? And in fact, actually, one of the comments is very, very telling, which is that it's a solution looking for a problem, CBDC. So it looks like a technology hammer that is searching for a nail, something like that, okay? So really, is there a value at all in CBDC is also a question that's getting asked. So there is some amount of skepticism that is starting to creep in on what the purpose of CBDC is, and specifically in India, this skepticism is a little bit more, primarily because of the unified payment interface which has been so successful and which serves most of the needs of customers, and we can't really see why CBDC will add any value to it. But still, I'm going to make a case for it, okay? That is the point. Though I'm saying all these negative things, I'm going to make a case for CBDC. Okay, so the question that comes really is, why should banks adopt the e-rupee, which is the India CBDC? If you decide to give interest on CBDC, then there is a danger basically that people might convert what they have in their savings bank accounts, which means the bank deposits, into CBDC, because CBDC is also giving you interest, and you don't have to be dependent on a bank, right, to use it, because it's much more liquid and so on, and you can transfer it much more easily using a phone, mobile phone, for example. So why would anybody keep their money in a deposit? And if you don't keep your money in deposits, then the bank doesn't have a low-cost source of funds from which to create credit, right? So there's going to be a huge impact on banks if the CBDC becomes interest-bearing. And so therefore, many central banks, including India, and I'm told that Indonesia's, the central bank is also thinking about a CBDC which does not give interest. So a non-interest-bearing CBDC is what they've implemented in India. Because if you do interest-bearing CBDC, then this might basically disincentivize banks, and banks may not be very encouraged to actually try it out, okay? But the question is, if you're going to do a non-interest-bearing CBDC, then it's not interesting for consumers, all right? If it's interest-bearing, it's a problem for banks. If it's not interest-bearing, it's not interesting for consumers, because why would I put my money in a CBDC when I can keep my money in a savings bank account, which is interest-bearing? And if I want to do a digital transaction anyway today, Unified Payment Interface is there in India, UPI is there, and in other countries, you have other methods of digital payment. You can use digital payment, and you can do your payments and so on from the bank account directly, and you're also getting interest. So what is the interest? Why would I take money out and keep it in CBDC? Of course, then you can argue that people do take their money out and keep it in cash form. Yes, they do that, but primarily they do that because much of the transactions they do with cash, they want it to be anonymous, maybe. That is the reason they keep it in cash, or it's more convenient because digital payment is not accepted in many places. So cash is anonymous, CBDC is not anonymous, at least the online version of CBDC is not anonymous. We can discuss later. I will show you a slide where I'll discuss the offline version. What is the problem with that? But it is not anonymous, right? CBDC is nowhere near anonymous, and in fact, Huzur gave a very nice example of crypto itself not being anonymous, that you can trace it and so on. CBDC is even worse, right? So there is another problem with CBDC, that it's not a good replacement for cryptocurrency, and that is because cryptocurrency is speculative, so therefore has an asset-like value. Means the value of this cryptocurrency keep going up, CBDC's value will not go up, okay? So there is a very nice comment by the Deputy Governor of the Bank of England, where he says that if a CBDC is just a substitute for cash, then he can't see why anybody would not simply keep their money as a deposit in a commercial bank. Why would they keep it in the form of CBDC? So there is skepticism across the board on CBDC, as I'm explaining, right? Across the board. This is coming from the Central Bank of England, right? Now, I explained already two kinds of issues, right? One, basically interest-bearing and non-interest-bearing. If it was interest-bearing, it affects banks' credit. If it's not interest-bearing, people don't see the value of it as compared to cash. Now, at the same time, you could have it as token-based or account-based. The problem with token-based is it can be misused, right? It's like crypto, so it can be misused. If it is, on the other hand, if it is account-based, then it has to be online. It cannot be offline, and there is no anonymity, because the whole idea of having it account-based, to open an account, you need to do your know your customer, KYC and all that. So basically, then it's not anonymous anymore, right? So India's CBDC is entirely account-based, right? And therefore, and it's basically done by banks, and so has KYC and so on. So there is no anonymity in the CBDC at all. The third one, of course, is technology, which I don't want to discuss too much in today's talk. But should you use a centralized system or should you use a token-based system? I mean, should you use a distributed ledger system, which is a blockchain system? If you do centralized, the problem is that there is a single point of failure. On the other hand, if you do a blockchain type of model, it's energy intensive, it's complex, it's not scalable, and so on. So most banks are basically thinking, or most central banks are thinking about a solution that lies somewhere in the middle. I'm told that in Indonesia, they're thinking about the wholesale being blockchain-based and the retail being centralized. And India is mostly centralized right now, though they're keeping the option to introduce blockchain, again, for the wholesale transactions later. Okay, so, one question that can come to your mind is, why don't we simply think about a cryptocurrency, the CBDC, as some kind of a token, right, that is held by a device and then can be exchanged. Now, the problem with a digital token is that it can be copied. And unlike cash, which is hard to, because the way they make the instrument, very hard to copy the note, right, treasury note, the digital currency can be very easily copied. And if you see the copy of the bits, it's going to look the same as the original. It's very hard to make out the copy from the original. And once you allow a coin to be copied, a digital currency to be copied, then the value of the currency disappears, right? There's no value for it. So how do you prevent it from being copied? The only way to do it is you have to rely on the device to be secure. So you have to have a mobile device, right, which is secure. That means there's a secure vault in it where you keep the digital currency, and it should be tamper-free. You should not be able to access that secure vault where the digital currency is kept. Now, making that, I can tell you from my experience of making phones with the security device, in it is very, very, very hard, okay? There are 100,000 ways in which people figure workarounds to get access to the insides of the phone, all right? So if you don't want to do that, then the other way to do it basically is to keep a record of the ownership of the digital currency elsewhere. So you can keep it either in a distributed ledger or you can keep it in a central server, but then basically it's not anonymous. So what I mean to say basically is that anonymity and security, they don't go well together, right? Either you can have security or you can have anonymity. You cannot have both, right? Now, offline CBDC needs many, many safeguards. So there are two versions of offline CBDCs that are being discussed. One is what is called intermittent. So intermittent basically means that I have a device, I can transfer a CBDC to your device, but you can't transfer that CBDC further to anybody else, okay? If you want to transfer it, you have to first get access to the internet. So I do this device to device using Bluetooth or something. But if you want to transfer this CBDC to somebody else, you need to first connect to the internet. That's called intermittent. And the other thing is called extended, and extended basically means it's transitive. I can transfer it to you and you can transfer it to somebody else. But clearly, this has many security vulnerabilities. You can imagine that the minute I allow people to transfer CBDCs like this, I cannot trace its ownership very easily, and because of that, maybe things are getting copied and so on. You don't even know whether or not the CBDC is valid anymore, right? So this is the problem that we are facing in extended. So most people, when they talk about offline, they most likely will be implementing only intermittent CBDC transfers, which means offline I can transfer it to you, but you are a merchant, let us say, you will have to connect to the internet and then you have to basically reclaim your money, right? Now, if you compare CBDC with crypto and cash, right? So you see that crypto has the key advantage that it is an asset, and cash has the key advantage that it has an anonymity. So if you stare at this comparison diagram, you can ask, what is that one advantage that CBDC has, right, which is different from the others? Very hard to spot it. You have to look at it carefully. But if you look at it, the one advantage CBDC has is that it is digital, unlike cash, and you don't need an account to hold it, right? So in India, you can have your money in a bank account, and then you can use UPI, that is Unified Payment Interface. UPI is only valid for people who have bank accounts. So CBDC, the only clear differentiation that comes out for CBDC is that it is advantageous for those people who do not have bank accounts, but still want to do things digitally, all right? So this is the way I'm trying to make a case for CBDC, and this is the case I presented to the Reserve Bank of India also, and they're very encouraged by my presentation. And I said basically that we should keep the focus of CBDC on financial inclusion. In India, there are a very large number of people who are unbanked, and even more importantly, there are many people in India who are underbanked. I'll explain what that means, right? And that is true, I'm sure, in many emerging countries. I'm sure that's true of Indonesia also. There are many people who cannot access the bank accounts that easily, right? So keep it focused on financial inclusion, formalize the informal sector, which is where you have these many underbanked people. What it does effectively is by giving CBDC to people who don't have bank accounts, you're actually enlarging the number of people, not just financial inclusion-wise, you are basically making the central bank's reserves accessible to the public at large, not just to the banks. So when you make it accessible to the banks, people who have bank deposits get access to it. But by going beyond the banks and giving it directly to the people at large, you have this concept which is called reserves for all. Reserves for all, central bank's reserves is now accessible to the public at large. It gives you a sense of democratizing the central bank's reserves, okay? That's what it is. And of course, the question can come, if you don't have banks, how do you distribute this CBDC? And how do you create credit and all that? And the answer, according to me, is through fintech, all right? So fintech can directly deal with, on one side, can deal with crypto, this kind of, like they're doing with cryptocurrency, they can deal with CBDCs directly and work with the bottom of the pyramid, okay? The Reserve Bank in India, which is a central bank in India, basically understands that this is a potentially powerful force, which is why they created an organization which is called the Reserve Bank of India Innovation Hub in Bangalore. And the company that I founded, Agami Fintech, is part of the RBI Innovation Hub. And basically what they're doing is they're encouraging fintechs basically to come up with these interesting solutions. They created a sandbox where we can experiment with some of these things and roll it out. Okay, so the total stock, I think this figure on the right is not showing up, but the total stock of migrant labor in India is about 40 million people, okay, roughly. Migrant workers, migrant labor. And you can see in this diagram, I'm showing you the flows within India of this migrant labor. Specifically for the South India, where I come from, Tamil Nadu, a lot of our migrant labor comes from Assam, Bihar, West Bengal, that is the northeast of India. So they come from northeast of India, and a lot of migrant labor that go into the state of Maharashtra, for example, Bombay and so on, they are going from Bihar to Maharashtra, right? So there are certain well-known flows of migrant labor in India. And this migrant labor have specific issues with payments, right? Now, typically, if you look at the migrant labor population in India, these 40 million workers, of which about 3 or 4 million are in my home state of Tamil Nadu. If you go there, you find basically that these migrant workers are recruited not directly by employers, they're recruited by intermediaries called agents, because these agents, they work with them in their hometowns. Let's say somebody from Assam is working in a factory in Tamil Nadu. So the agent goes and discovers these people and brings them to the factory, and the payments are made via the agent. So the company pays salary not to the employee directly, but pays it to the agent, and then the agent will deduct some fees and so on, various other things, and passes some part of the salary back to the employee. So these intermediaries are very costly, firstly, and they create a lot of friction because while the intermediaries are supposed to take care of compliances, like for example, paying provident fund and insurance amounts and so on, they don't necessarily file those things in time. They don't necessarily make their payments to the employees on time. They're very non-professional, right? These agents are non-professional. And this creates friction between the agent and the employer, creates a friction between the agent and the employee, and creates a huge amount of friction between the employee and the employer. And when we did a survey and explained what we did, we found that this was a predominant issue that was facing the companies, right? Companies were basically complaining that we are struggling with this migrant labor issue, right? What is the issue that we are having? So what we did really is we did a pilot in the company that I founded. We did a pilot and we did survey in 3 locations. One location is a place called Dindigal, which is in south of India. It's a textile manufacturing plant. You know, India's textile manufacturing industry is very big. So this particular plant, this single factory has 4,000 migrant workers. And we did a pilot by giving them a mobile application. It's a closed wallet solution for 100 workers. We picked random 100 workers and we gave them this solution just to see how they use the money. So we gave them all their salary on their mobile phone and they asked them to spend it. So the app would allow them to spend it, right? So they were able to use that app and they were able to spend the money. And we checked out, we tried to find out what they did with the money. Okay, that's basically the pilot. And similarly, we did a survey, right? Based on this pilot, we ran a survey with 2,000 employees in an auto component company in a place called Hosur, which is south of Bangalore, and with a manufacturer of sports gear, right, in Chennai. About 1,500 workers. So altogether, we reached out to maybe 5,000 or 6,000 workers and got a lot of feedback. And what did we find? We found basically that most of the migrant workers don't like to have the money in their bank account because withdrawing money from the bank account means going to an ATM. An ATM may not be very easily accessible near their factory location. So they have to go somewhere else to get the money, and that takes time, and it's costly. So they like their money in cash. Even if they go to the ATM, they withdraw their money, their entire salary, whatever is deposited in the bank account, they withdraw it in one shot and bring it as cash, and they keep their money in cash, okay? So the bank account is just used temporarily for 1 day, maybe, maximum, right? That's what we found. The other is that though India has a very high coverage of bank accounts today, these accounts are what are called zero balance accounts, which are accounts where, because people withdraw their money immediately after the salary is deposited, they withdraw all their money. The zero balance accounts allows you to maintain a balance of 0 in your account, okay? But the problem with zero balance account is that if you use the zero balance account to do anything, even to do a transaction where you try to find out how much money you have in your account, even that is charged, okay? Everything is charged. And we found that the employees are spending 2 to 3% of their monthly salary just doing transactions with their zero balance accounts. Okay, it's a very substantial sum of money for poor people, right? These are people who are earning wages of 8,000 rupees a month, which is like $100 a month. So, but at the same time, we found that their financial needs are very, very limited. So what do? They typically get their salary, they transfer part of their money to their families back home. They withdraw some cash and use it for buying some things, and they recharge their phone bills, mobile phones, and they may be purchasing tickets for travel, and then they lend money to each other. Basically, this is it. More or less, if you take these 5 use cases, it covers most of their requirements for payment. All right. So very, very simple use cases. For a fintech, this is very encouraging because you can make a very nice, simple app with good logos and so on. We just focus on these 5 use cases, for example, and that is much more valuable to the migrant worker than anything else, right? So the solution that we came up with today, and it doesn't use CBDC because unfortunately CBDC is not allowed to be used by fintech companies, is something like this. So what we do is that we use India's biometric system, which is called Aadhaar, to enroll or onboard an employee. So we have a mobile phone which is connected to a biometric device. So we go to the factory floor where when a new worker is coming in, he just puts his fingerprint, it goes to the Aadhaar database, retrieves his records, and we're able to enroll that person into a bank, into our system, into the bank. We're working with Yes Bank, which is one of the banks in India. So it enrolls him into an account in the Yes Bank, actually, right? And what we give that person then and there is a pre-configured app. Pre-configured in the sense that the app will have all the beneficiaries that he wants to transfer money to, everything fixed, so that the person doesn't have to figure out how to add a beneficiary, do any of those things. All that is done for him. And we give them a card, what is shown here. We give them a digital card like that. And when their salary is processed every month, it gets transferred into our account. We then make the payments, statutory payments, and we transfer the balance to the employee. The employee can use the app to do many things, like check their balance, make bill payments, withdraw cash, send money to their family, and so on. And they can use their card for doing ATM transactions, for point-of-sale transactions. All right. So this solution, which is under development, we believe will basically become successful. We have not rolled it out yet. We are in the process of rolling it out. But because we have done a pilot already with the closed wallet, we know that this is going to work, right? Now, what is the advantage of CBDC compared to this? The main advantage of CBDC is we can knock out this card. Had we CBDC, if we had central bank digital currency, we can knock out the card altogether and do everything with just the app, okay? That's the advantage. And I think the real value of CBDC will come only if you focus segments like this, which are non-banked, unbanked segments, underbanked segments, where CBDC can be used as a replicate, as a substitute for cash, right? Even though it's not interest bearing, it's a substitute for cash, but can be transacted digitally with your phone, right? So that is my summary of my talk. To just quickly summarize, what I pointed out to you is that CBDC design is complicated. Too many conflicts in the choices that are there in CBDC. Should you make it token-based? That's a problem. Should you make it account-based? That's another problem. Should you make it interest-bearing? One type of problem. Don't make it interest-bearing, another type of problem. Too many issues with the design of CBDC, which is one of the reasons why CBDC is not taking off. There is skepticism, right? One has to pick one thread and go through with it using CBDC. My recommendation basically is that one picks financial inclusion, which is a very, very big goal for countries like India, emerging markets, and push through on that thread, and potentially CBDC, as I explained with the case study, has some potential there. Thank you.
Thank you, Professor Venkatesh. Any questions? Yes, please, Dr. Rajiv. Okay, I give you the mic. It's really nice to see you again this year.
Yeah, thanks, GV. Great talk. Very, very interesting. GV, just out of curiosity, how secure is CBDC? I mean, because it's going to be used by the masses, security has to be one of the top objectives. How do you address that issue?
How secure is it? Is your question? Yeah. So, I mean, security issues are the same as, bank deposit. Is bank deposit secure? You can ask the same question. You digitally transact with the bank today. You make payments to the bank. You can access your bank account and so on. CBDC, if it is account-based, as it is in India, it's the same thing. It's just another account that is being maintained, in which instead of having your deposit in the normal form, it will be kept in the CBDC form. So it's just as secure as a bank deposit is. No difference. Today, okay, if you did token-based CBDC as is cryptocurrency, then questions come about security, like I explained. Especially if it's offline. Then only the questions start coming up. Yeah.
Questions? Okay, hold on.
Yeah, thank you so much, Professor. Very interesting use case about your fintech being involved with that payment solution. So now, at what stage of the development is it right now? So you'll still be the workers will still be using cards. And then they'll be using that. But so, what's the added benefit rather than having a normal banking card?
For the user, you're saying? So
yes,
we are right now in stage of, let's say, alpha trials, limited pilots we are doing right now with our solution, and we will be rolling it out sometime in the next financial year, which means our financial year starts in April. So we'll start maybe in April or May of 2024 is when we'll actually seriously roll it out. Now, the advantage is that the people don't have to go to a bank branch or an ATM to use our solution. Okay, because they can do everything. For example, if they want to transfer money to a family member, they can do it from their mobile phone, sitting in their office or in their workplace, right? Or if they want to see their bank statement, they can see it directly on their phone. Or if they want to do any of the things that I put through the app. Only if they want to withdraw cash, right? Even for cash, we have two solutions. One is you use your card and go to the ATM and withdraw your cash. The other way is that we have this, in India, we have this Aadhaar-enabled payment system, which means it's a point-of-sale type terminal, right? Biometric device, yes, which you connect to a mobile phone. So we have our own agents in the factory floor who will basically carry these Aadhaar-enabled payment system, this point-of-sale type devices, where they can just use their mobile phone, right, and then get cash. So these are easy, convenient cash points, which will be there in the factory floor.
Okay, interesting.
So they can do majority of the transactions that they are normally doing today, they can do it with just their phone in a very convenient way. That's the advantage for users.
Okay, so the monetary benefit comes through the percentage of cut you take from the salary.
Who? For us?
Yes.
For the company?
Yes.
So the company basically will be making money from the employer mainly, because we are processing payroll for the employer, we are taking care of a lot of the hassles for the employer and so on. So we are making, that's where we make our significant amount of money, right? We are not going to charge the customer a very large amount of money. There will be a small fee that we will charge the customer, but it's not much. But our major source of revenue is not expected to be customer, it's expected to be the employer. And other service providers like mobile phone companies, because we are doing bill pay and all that, all the companies that want to provide services to any of these migrant labor, we will charge a commission to them, not to the customer.
Okay, that's interesting. So there could be also an option that where you could also get rid of a menace of loan sharks. So probably there could be an option where they could get a payment based on the number of works they have already done. Because sometimes what happens is that they have a short supply of cash, but even though thing.
So that's
that
the
would
thing.
be
So
potential option.
most of the payments today are by cash, and which is why Reserve Bank is very interested in us, because if we are able to push many of these migrant laborers towards digital form of payment and everything, away from cash basically, then it helps them also, because they have moved that segment onto the formalized part of the economy, right? Because you can now trace their expenditures, you can do many things, because it's not digital. So yes, so the idea would be to move them away from cash, if possible.
That sounds very good. Sorry, I have to add one more thing. There's another company in Indonesia who you look like. They're doing something similar, but what they're doing is that they're going to all these kirana kind of a stores where they have a face recognition applied. That could be an additional
So face
payment for the
recognition,
face.
so we considered for our enrolling, we thought of many technologies. So in India, there are many ways in which you can enroll a person. One of them is what is called video KYC, which is just face recognition is dangerous,
Yes.
because you can fake very easily, but video is hard to fake, all right? So in India, we don't use static images, we use video KYC, right? Because you'll be asked to do something,
Yes.
and or say something, read something, and based on that, KYC is done. So we considered video KYC, we considered biometric, which means using fingerprint and so on. After trialing out many things, we found biometric to be the most reliable. We have just 5% failure rate, 95% success rate on biometric, whereas video KYC fails many times. So which is why we decided against that.
Very interesting. Thank you so much. Really appreciate it.
Thank you so much. Any other question for Professor Venkatesh? Okay, sir, hold on. Let me give you the microphone, please.
Yeah, GB, just curious. But another reason for CBDC is that there is a cost of printing money, right?
That's correct.
And there's a cost of printing money and cost of minting the coins. What is the typical cost in India? I mean, or anywhere?
Not known, I mean, nobody knows the exact number, but it could be anywhere from 0.1 to 0.4%, okay, of the value of the note. We don't know the number because nobody publishes it. But, I mean, interestingly, notes, there is a cost. For coins, there is a benefit that the Reserve Bank makes. It's called seigniorage, right? The Reserve Bank, because the amount of material that go into making a coin, the value of that is less than the value of the coin. So the minute you make a coin, the difference is actually transfers into the reserves of Reserve Bank of India. So whenever they issue coins, actually they make money, right? But notes is not like that. Notes, there is cost. Yeah.
Okay, any other? Yes, one more question.
Okay, thank you, Doctor, for your insightful and wonderful presentation. So first of all, I would like to say thank you because, as someone that doesn't have any background in financial technology, I always getting confused about, the differences between cryptocurrency and digital currency and stuff. And because of your presentation, at least I can know a little bit about that when, like why cryptocurrency is banned, something like that, because, it's still seen as an asset and can be like manipulated by some other people and stuff. While digital currency is, like enforced to be used with some all of like advantages that you've been explained. So my question is, CBDC has been like been around in India maybe around like 1 year and more. And even though it has like some kind of like ambitious target to reach 1 billion, I think, or million retail transaction in December 2023. Even though it's still like maybe achieve like around 2% and around more. So my question is, even though there is some kind of like a pilot project that you've been explained, you know, in migrant workers, but in in a bigger scope, how's the migration process, you know, from the cash base to the digital currency base? Is there some kind of like difficulties and stuff that has been like maybe happen in India? And also how big the usage of the digital currency has been used or has been covered in the India? Thank you.
Okay, so there is no specific target to migrate cash to CBDC in India as yet.
Okay.
But the general thinking is that cash, the economic principle is that cash has storage cost. And there is friction because you have to, it's also work to get cash, right? You have to go and withdraw the cash, so there is work in getting the cash. Whereas to get either a cryptocurrency or to get a CBDC, it's just digital. You do something with your phone and you get it. So there is no friction in getting the cash, and there is no friction in spending it. So therefore, and there is no storage cost because there's nothing, you don't have to keep it somewhere like in a wallet or in your safe or under mattress or wherever it is you keep your cash, right? So you don't have all those storage costs. So therefore, intrinsically people, if they find value in in this kind of things, they will move to it. So there is nothing you need to do specifically to push people towards this. If people aren't moving to it, it is only because they don't find a value in using it. That is what it is actually, right? So your second question was about crypto, right? In India, they have decided that cryptocurrency should be banned because cryptocurrency is an asset. Yeah. And in India, we don't allow Indian rupees to be used to buy foreign assets. Cryptocurrency is not an Indian asset, it's a foreign asset. And so we have a Foreign Exchange Management Act, which prevents citizens of India, or residents of India really, to hold foreign assets, except in a limited way, right? There's a limited thing called, limited way in which you can buy assets abroad, right? Very, very closely monitored. Because the foreign exchange is not floating, it's not exchangeable freely, it's a controlled foreign exchange. And so we have this act, and therefore because cryptocurrency is an asset, they decided that they will not allow Indians to buy cryptocurrency, right? And never was cryptocurrency allowed as a means of tender, legal tender anyway, right? So for it to be a legal tender, it has to be passed by Act of Parliament, which is not, so it's not going to be legal tender in any case, right? So that's out of question. So that is why cryptocurrency in India, if at all it is being used, it's only being used for illicit purposes. And accounts maintained abroad, not in India.
Okay, thank you for your explanation. So one of the things that I can get is, CBDC doesn't, like to be like ambitiously implemented in maybe near years, but maybe like for like long term, and maybe raise awareness is something that have to be like did first until getting it to be like implementedly.
No, I think there's a lot of future in CBDC, like you point out.
Yeah,
I think there is this whole concept called programmable money. I don't know if you've heard about it.
Yeah.
But for example, what interest rate would you set on the CBDC? Assume for a moment that we are going to introduce CBDC with interest rate. It will come, I think, in the long run. If you're going to introduce interest rate, what should be the interest rate? Should it be fixed? Should it be variable? If it's variable, what conditions will monitor change? Will it be market conditions that will change the interest rate? Yeah. If so, how do you implement it? You see, think about all these things. So all this requires for you to have what is called programmable money, right? And platforms today, DLT platforms, blockchain technology platforms, allow you to implement programmable money, actually. So there is a great future, I think, in this instrument. I see. Yeah.
Okay. Thank you very much for your answer, sir.
Thank you.
Thank you so much for the question. Any other question for Professor Venkatesh? Any other questions? Okay, Professor, that wraps your talk, your session. Thank you so much. On blockchain, CBDC, and data privacy, SASKEN Technologies Limited, Bangalore, Professor Venkatesh. Thank you so much. Ladies and gentlemen, we are about to finish today's event.